Most traders fail because they refuse to lose. Sounds strange, right? But what if I told you the fastest way to win is by mastering how to lose? I still remember one of my worst trading days. Hours of analysis, the perfect setup, and then a loss so painful it almost made me quit. But here's the twist. That loss became the turning point that changed how I trade forever. In this video, I'm going to show you how learning to lose, intentionally and strategically, can become your greatest trading edge. If you've ever felt crushed by a losing trade, stay with me, because by the end, you'll see losses in a completely different way. The truth about losing. Here's the uncomfortable truth about trading. It's not about winning every trade. In fact, the best traders in the world lose, constantly. The difference is they know how to lose the right way. The biggest myth in trading is the search for the perfect strategy. New traders believe if they just find the right setup, they'll never lose again. But that mindset is deadly, because the moment a trade goes against them, emotions take over. And that's when accounts get blown. Statistics show that over 90% of retail traders eventually lose their capital, and it's not because their strategy is bad, it's because their psychology breaks down. Even profitable strategies fail in the wrong hands if the trader can't handle losses. The truth is simple. Trading is a game of probabilities. Winning consistently doesn't mean avoiding losses. It means managing them. The traders who survive aren't the ones who win the most. They're the ones who lose the best. The psychology behind losses. So why do losses hurt so much? It's not just numbers on a screen. It's your brain chemistry working against you. When you win a trade, your brain releases dopamine, the reward chemical. It feels exciting, addictive, almost like a rush of gambling. But when you lose, your brain floods with cortisol, the stress hormone. Your heart races, your palms sweat, and fear takes over. That chemical spike makes you want to immediately fix the loss, which often leads to revenge trading. This is called loss aversion bias. Psychologists discovered that losing money feels about twice as painful as the pleasure of making the same amount. In other words, losing $100 hurts way more than winning $100 feels good. That's why so many traders sabotage themselves. They'll risk huge amounts just to avoid feeling that pain again. And here's the kicker. Your brain wasn't built for modern markets. Thousands of years ago, losses meant danger, losing food, shelter, or safety. Your ancient brain still reacts the same way today. Except now, instead of running from a predator, you're running from a red candle on your chart. Until you learn to rewire that response, the market will always control you, because it knows your biology better than you do. Lessons from first losses. Ask any trader about their first big loss, and you'll see the same expression. It's unforgettable. For me, my first major loss felt like failure. I had spent hours analyzing the setup. Everything looked perfect. And then the market flipped. In just a few minutes, I lost more money than I thought possible. My stomach sank, my chest got tight, and the thought running through my head was, maybe I'm not cut out for this. That's the emotional impact of early trading experiences. They don't just hit your account balance, they hit your identity. When you're new, it's easy to tie your self-worth to your results. If I win, I'm smart. If I lose, I'm worthless. And that mindset is poison. Looking back, that painful first loss was actually the beginning of discipline. It forced me to ask the hard questions. What did I do wrong? How do I protect myself next time? It was the moment I realized that losses weren't the enemy. They were teachers. Your first losses are like a mirror. They show you who you are under pressure. The key is not to avoid them, but to use them as fuel for growth. Because the traders who mature are the ones who stop saying, I lost, so I failed, and start saying, I lost, so I learned. Breaking destructive cycles. Now let's talk about one of the most dangerous traps in trading. Destructive cycles. It usually starts with one painful loss. Instead of accepting it, you jump back in immediately, trying to get it back. That's called revenge trading. The problem is, you're no longer trading the market, you're trading your emotions. And the more emotional you get, the worse your decisions become. Traders call this state tilt. It's when frustration and anger completely hijack your logic. In tilt, you'll risk too much, ignore your rules, and spiral into bigger losses. I've been there, and it's brutal. So how do you break the cycle before it destroys your account? Here are 3 quick reset techniques that I still use today. 1. The 60-second breathing reset. Close your eyes, inhale slowly for 4 seconds, hold for 4, exhale for 6. Just 1 minute of controlled breathing lowers cortisol and clears your mind. 2. The walk-away rule. If you hit your daily loss limit, step away from the screen. Go outside, move your body, reset your state. The market will always be there tomorrow, but your capital won't if you stay in tilt. 3. Journaling your emotions. Before you re-enter the market, write down what you're feeling: anger, fear, desperation. Putting emotions on paper separates you from them. It gives your rational brain the chance to step back in. These 3 resets are simple, but they're powerful. They stop the downward spiral before it even begins, and that's what separates a disciplined trader from a reckless one. Professional loss management. Here's the biggest difference between amateurs and professionals. Amateurs treat losses like personal failures, while pros treat them like business expenses. Think about it. If you owned a restaurant, you'd expect to spend money on ingredients, staff, rent. Those aren't losses, they're costs of doing business. Trading works the same way. Every loss is the price you pay to operate in the market. So how do professionals manage those expenses? They use simple formulas. Risk per trade. A pro decides before entering how much they're willing to lose, usually 1% or less of their account. If the trade fails, it's already budgeted. Max daily loss. They set a hard limit, maybe 2% of their account. Hit that number and they stop trading for the day. No exceptions. Recovery mindset. Pros don't try to win it all back in one trade. They think long-term. One loss doesn't matter if the system works over hundreds of trades. Now picture this. An amateur loses $500 and panics. They double their position size, hoping to recover, and end up losing another $1,000. A professional loses the same $500, shrugs, logs it, and comes back tomorrow like nothing happened. Same loss, 2 reactions, 2 completely different outcomes. That's why the pros survive and the amateurs burn out. Building loss training habits. If you want to become a consistently profitable trader, you can't just manage losses. You have to train for them. Think about it like going to the gym. You don't walk in and lift 200 pounds on day 1. You start small, build strength, and over time your muscles adapt. Your brain works the same way with losses. The more you expose yourself to them in a controlled way, the less power they have over you. Here are 3 practical exercises you can use to build what I call loss training habits. 1. Micro trades with controlled losses. Take very small positions where the dollar amount is almost meaningless. The goal isn't to win money, it's to feel the loss without fear. Over time, your brain starts treating losses as normal, not catastrophic. 2. Daily P&L journaling. At the end of each day, write down not just your profit or loss, but also your emotions. Did you feel fear, anger, confidence? This trains you to see patterns in your behavior, not just in the market. 3. Role-play worst-case scenarios. Ask yourself, what if I lose 3 trades in a row? Then rehearse how you would respond. By planning for the worst, you remove its power to shock you. The magic is in the repetition. Just like building a muscle, every small rep of loss training builds resilience. Over weeks and months, your emotional response to losses becomes calmer, more controlled, more professional. And once losses no longer scare you, you stop trading from fear. And that's when consistency finally clicks. Shifting identity. One of the biggest breakthroughs in trading isn't about charts or strategies. It's about identity. Most traders tie their self-worth to their results. Win a trade? I'm smart. Lose a trade? I'm a loser. That emotional roller coaster destroys confidence and keeps you stuck. Here's the shift. Stop labeling yourself based on outcomes. A loss doesn't make you a loser. It makes you a learner. Every trade, win or lose, is feedback. It's information you can use to improve. The most successful traders don't measure themselves by individual trades. They measure by consistency. Did they follow their plan? Did they respect risk? Did they stay disciplined? If the answer is yes, then even a losing trade is a success, because the process was correct. Think about it. A doctor doesn't feel like a failure every time a patient doesn't respond to treatment. A scientist doesn't quit when an experiment fails. They see results as data. Trading works the same way. The moment you stop saying I'm a loser and start saying I'm a learner, everything changes. You free yourself from the emotional trap of results and step into the mindset of a professional. Because in the long run, it's not about winning every trade. It's about becoming the kind of trader who can handle any outcome. The 3 stages of trading maturity. Every trader goes through stages of maturity. The question is, where are you right now? Stage 1, the amateur. This is where most people start. Amateurs are obsessed with wins. They celebrate every green trade like they just cracked the code and panic at every red candle. They're constantly strategy hopping, chasing signals, believing the next big win will solve everything. The problem? They measure success by outcomes, not by discipline. Stage 2, the struggler. This stage is an emotional roller coaster. You've realized that wins and losses both come and go, but you're still ruled by fear, greed, and frustration. Some days you feel on top of the world, other days you want to quit. Most traders get stuck here, cycling between confidence and despair. Stage 3, the professional. This stage doesn't look glamorous. It looks almost boring. Pros follow their plan day after day, regardless of wins or losses. They see trading as a business, not a casino. Instead of chasing excitement, they chase consistency. And ironically, that's where the real money is made. So let me ask you, which stage are you in right now? Amateur, struggling, or are you moving toward professional? Wherever you are, remember this. The goal isn't to skip the stages. The goal is to grow through them. Every stage teaches you something essential, but the faster you shift toward the professional mindset, the faster you'll stop bleeding money and start building consistency. Turning pain into progress. Here's something most traders never realize. The pain you feel from losses isn't punishment, it's tuition. Think of it like paying for an education. Every losing trade is a lesson you've paid for. The difference between amateurs and professionals is that pros actually collect the lesson. They ask, what did this loss teach me? While amateurs just try to forget it. And here's the key. Your real trading edge doesn't come from the perfect strategy. It comes from emotional stability. Anyone can follow a setup, but very few can stay calm under pressure, stick to their rules, and keep showing up after setbacks. That's what creates consistency. There's a saying I love. The most boring traders make the most money. Why? Because they've already felt the pain, they've learned the lessons, and they no longer need the thrill of the market to feel alive. They just execute their plan, day after day, month after month. So the next time you feel the sting of a loss, don't see it as failure. See it as tuition you've paid toward becoming a professional. Because every ounce of pain you endure now is building the emotional strength that will make you unstoppable later. Case studies of legendary traders. Now, if you ever feel crushed by a losing streak, remember this. Even the greatest traders in history have been there. Paul Tudor Jones once said, "Losers average losers." Early in his career, he learned the hard way that adding to a losing position only makes the pain bigger. That lesson shaped his risk management philosophy, and he went on to become one of the most successful hedge fund managers ever. Ray Dalio, the founder of Bridgewater, lost so much money early on that he had to borrow from his dad just to survive. Instead of quitting, he reframed his failure as research. That mindset turned Bridgewater into the world's largest hedge fund. And then there's Jesse Livermore, one of the most famous traders of the 20th century. He made and lost multiple fortunes in his lifetime. His story is a reminder that even legends can fall if they let emotions override discipline. The point is this: losses don't disqualify you, they shape you. Every great trader has scars, but those scars became their wisdom. The difference is they didn't run from their losses. They studied them, learned from them, and used them to build strategies that stood the test of time. So when you lose, you're not off the path. You're walking the same road every legend walked before you. The risk-reward mindset. Most new traders think success is about having a high win rate, winning 70, 80, even 90% of trades. But professionals don't think that way. They think in risk-to-reward ratios, not win percentages. Here's why. Let's say your risk-to-reward ratio is 1:3. That means for every $100 you risk, you aim to make $300 when you're right. Now watch this. If you take 10 trades and you only win 4 of them, you're still profitable. 4 wins, $300, $1,200. 6 losses, $100, $600, net plus $600 profit. You only won 40% of the time, but you still came out ahead. Compare that to an amateur who wins 7 out of 10 trades but risks $300 to make $100. 7 wins, $100, $700. 3 losses, $300, $900. Net, $200 loss. They won more trades, but they lost money. This is why professionals don't care about being right all the time. They care about structuring trades so that their winners outweigh their losers. It's about playing the math, not playing the ego. When you start thinking in risk to reward instead of win rates, you stop chasing perfection, and you start trading like a professional. Building a loss-proof trading plan. If you want to survive long enough to succeed, you need a trading plan that doesn't just assume wins, it assumes losses. Most beginners design plans around the perfect setup, the dream entry, or the ideal strategy. But professionals know the real question is, what happens when this goes wrong? A loss-proof trading plan has 4 key components. 1. Entry rules. Be specific about what qualifies as a trade. Indicators, patterns, market conditions. Write them down. No guessing, no FOMO entries. 2. Exit rules. Decide both your stop loss and your take profit before you click buy or sell. That way emotions can't hijack you mid-trade. 3. Risk management. This is the backbone of your plan. Define your risk per trade, 1% or less of your account, and your max daily loss. If you hit that number, you stop. Period. 4. Emotional reset rules. This is the part most traders forget. What do you do when you feel tilt or frustration kicking in? Write down your reset protocol. Breathing exercise. Step away from the screen, or journal your emotions. The key point here is this. A plan isn't just for entering trades. It's for protecting your capital during drawdowns. Because drawdowns will happen, and the traders who survive are the ones who already prepared for them. Remember, amateurs plan for the best. Professionals plan for the worst. And that's why they last. Community accountability. Trading can be one of the loneliest careers in the world. It's just you, a screen, and your thoughts. And that isolation can amplify every emotional mistake because there's no one to check you when you're about to break your own rules. That's where community and accountability come in. Journaling publicly. Some traders post their daily P&L or trade reviews online, not to show off, but to keep themselves honest. When you know others are watching, you're less likely to take reckless trades. Having a mentor. A mentor can spot patterns in your behavior that you're blind to. They've already made the mistakes you're making now, and they can pull you back before you repeat them. Joining a trading group. When you surround yourself with traders who take the craft seriously, it changes your standards. If everyone around you journals, manages risk, and sticks to their plan, you'll feel the pressure to level up too. Accountability is like a safety net. It doesn't stop you from falling, but it keeps you from hitting the ground. Alone, it's easy to spiral. With accountability, you're forced to slow down, think twice, and stick to the habits that actually make you profitable. Because at the end of the day, discipline isn't just built in isolation, it's reinforced in community. The long game, thinking in years, not days. One of the biggest mindset shifts you'll ever make as a trader is this. Stop thinking in days and start thinking in years. Too many traders obsess over daily results. One red day feels like failure. One green day feels like they've made it. But here's the truth. Over a 10-year trading career, a single bad day or even a bad month means nothing. What matters is the bigger picture. Think about it. Grow your account by just 1% a week. That's over 67% in a year. Keep that up for 10 years, and compounding turns even a small account into something life-changing. Or, the traders who chase excitement burn out. The traders who chase consistency build wealth. Professionals don't ask, how much can I make today? They ask, can I follow my plan for the next decade? So when you hit a losing streak, zoom out. 1 week of pain doesn't define you. 10 years of discipline does. In the end, trading isn't about speed, it's about endurance. Play the long game and you'll discover that the real reward isn't just money, the real reward is freedom. We've talked about a lot today, but here's how you can turn these ideas into action starting right now. Step 1. Set a daily stop-loss limit. Decide exactly how much you're willing to lose in a single day. Once you hit that number, stop trading. This one rule alone protects both your account and your mindset. Step 2. Journal your emotions, not just your trades. Don't just write down entries and exits. Track how you felt. Fear, overconfidence, frustration. Over time, you'll spot emotional patterns that matter even more than price patterns. Step 3. Practice losing on purpose. Take small, low-risk trades where the outcome doesn't matter. The goal isn't to win, it's to get comfortable with loss. So when the real money is on the line, you don't panic. Do just these 3 things, and you'll start building the discipline and resilience that turn average traders into professionals. Remember, trading mastery doesn't come from avoiding losses. It comes from learning to use them. Losses are tuition. They teach you, they shape you, and they prepare you for consistency. Wins will follow naturally once you've mastered the art of losing. If this video gave you value, hit the like button, subscribe for more trading psychology deep dives, and share this with a trader who needs to hear it. And I'll leave you with this. The most boring traders are the ones who make the most money.